Welcome back to Yahoo Finance Live. Well, the U.S. economy adding 209,000 jobs last month, below expectations. We had the unemployment rate dipping just a bit to 3.6%, but wages, that key metric there that we know the Fed is watching very closely, coming in a bit hotter than expected. So what does this all mean for the Fed, and what's it going to take for the Fed to change its mind or hold off on future rate hikes? We got the all-star panel here to break it all down. Myles, Udland, head of Yahoo Finance News, here with us. Sam Rowe is back in the building, former managing editor of Yahoo Finance, a co-founder of the ticker, and Ann Barry is here with us, Threadneedle Strategies founder. So, Myles, let me kick it over to you first, just in terms of how the Fed is looking at a number like this. And I think the general consensus is still way too hot for what the Fed wants to see.
Yeah, well, we saw basically no reaction in Fed funds futures after this number because we kind of know the Fed is going to raise rates in a couple of weeks. And I think my question coming out of this, there's like on the one hand, you have the headline, which is, oh, jobs report misses. First time in 14, 15 months, I guess, that we've seen a miss relative to expectations. And to me, the question is, what do we need to see? What would we need to see from the labor market that would make the Fed change its mind and change what I think, and I'm curious in your thought on this, what I think is a pretty firm outlook on what they're going to do. Powell has said, here's how we're going to proceed the next few months. And I think the market believes him, clearly based on the pricing. You know, what would we need to see in the labor market to have him kind of change his tune?
Well, the market believes him finally, Myles, right? It's taken the ECB forum, it's taken a testimony on the Hill to get them to finally listen to what he's been saying all along, which is the data is looking, it's like it's going in this direction. And here we are. He's been like a parent having to repeat something to children over and over and over again, and that being the market finally is listening. I do think it's
familiar with that.
I think one of the things that we forget, Myles, is that the Fed has actually got a dual mandate. It's got to bring inflation down to that target at the maximum employment it can to hit that number. So I think at this point it's getting that wage inflation down. I don't think it's the unemployment rate, it's the wage inflation piece that needs to move.
Sam, how much, I guess, weakness do you think we are expected to see? If we do see 2 more rate hikes from the Fed, is that going to do it? Will we see that then eventually reflected in the labor market? Or that's higher for longer narrative seems like it's here to stay, at least for now?
Yeah, I don't know. I mean, so the unemployment rate climbs to 3.6% or whatever, and it's like, okay, down from a month ago, but it's up from its 60-year low of 3.4%. So the unemployment rate is still extremely low. So that gives the Fed a lot of room to, continue to make moves on monetary policy and interest rates and all this kind of stuff. But when you look at broad measures of inflation, like the CPI report and core PC and all these things, they've all been trending lower for months. So I don't know, directionally things seem to be going well for the Fed, and the fact that unemployment rate hasn't really budged and we still continue to get 200,000 plus job gains per month tells me that they have a lot of room to continue tightening.
And I think another question that kind of comes out of this jobs report and bigger picture, and like the story last week was the Bears finally have to give it up. Okay, the economy is doing well. Not only is the economy hanging in, but we're starting to see acceleration in some pockets. Housing is a big one. And we saw a little bit in the minutes on Wednesday, an acknowledgement from the Fed that housing might not be in the tank. Powell has, for months and months been like, housing is, depressed, this, that, the other. The stock market has disagreed with that for quite a long time. And you kind of wonder now if this jobs report is in service to the actual thing, the soft landing that so long ago was really mocked by, when Powell says things, everybody mocks it. But, your peers in the industry who were like, I believe in a soft landing, they were probably not having fun conversations with clients either.
Yeah, I think that's exactly right. And it's interesting on manufacturing specifically, and let's talk about the pockets, right? Manufacturing is the piece that looked like it's been heading into recession territory. But if you look at the jobs report today, that's actually where you see some pop, some uplift in actual job growth. I think in terms of the recession outlook, I've been one of those bears. I'm like waiting for Godot. When's it coming? When's it coming? It hasn't come. But the thing I do think is still something to watch is it's not just rates that the Fed can impact and that impacts the consumer, and this economy is built on the consumer. It's also credit availability. And one of the reasons I remain a bear is I do think there are credit issues coming.
So when you say you remain a bear, what is your outlook maybe for the next 6 months, but maybe let's do 18 months? What sort of, I guess without, putting numbers on it, it's what sort of downturn in your view does this economic setup portend us likely heading towards? It can always change, but, consumers being crunched on credit is not quite what we saw in COVID. That was just sort of this labor market panic. I mean, is this something that you think may be more protracted as these forces come through balance sheets?
Well, I think we're in this window. Let's take the terrifying 18-month window, right? Where
no numbers, it's fine. No numbers.
But a couple of that is going to be a window, I think, of a real realignment, right? I think we are going to see rates higher for longer, not just because we know the Fed's not bringing them down anytime soon, but because new debt is going to be issued now that locks in today's rates for a period of time. And that's going to create a stickiness as well that I think reins in not just consumer spending, but corporate CapEx budgets, right? Industrials figuring out how to spend. The return on those investments are going to go up because you can otherwise put things in a risk-free, hold treasuries. So I think there's been I think it's going to be a bit of a step function. And I think it's going to be lower than where it's been.
Yeah, and I think that's a really good point. You bring up the CapEx there for corporations. And Sam, I know you've recently written about this, and we have so much focus on the Fed. Obviously, earnings, a lot of that resulted just in terms of the guidance, the focus that's going to be on guidance here in this upcoming report, result of what the Fed is going to do with rates. But in terms of determining the direction of the market here going forward, how much, I guess, more are investors looking at those earnings results and what that could portend in terms of future action?
Yeah, I think that's a really good point. And to Anne's point, this question about higher interest rates and tighter credit conditions and higher credit costs and all these things are huge concerns. But one of these things we did see with corporations, there was a lot of refinancing happening in 2020 and 2021 where they were refinancing at lower rates and pushing out maturities on a lot of this debt. So, maybe rates are higher when they do have to refinance a lot of that debt, but they have a little bit of time there. And if there's one thing that we've learned from earnings season, we're probably going to learn it again this earnings season, is that corporations have had a remarkable ability to keep their profit margins high. And with profit margins near record levels, that also gives them some flexibility to take on some higher interest costs. So, and if there's also another thing that we've learned from this pandemic era with corporations, is that even with stuff like rising inflation, rising costs, difficult logistics to execute business, they still manage to figure out a way to keep profitability very high. So I don't know exactly how it'll work in 18 months or when this debt has to be refinanced, but you sort of have to wonder how corporations do get creative when it does come to confronting those higher borrowing costs when those bills come due.
And I think another question for me, Sam, is like, okay, what is the stock market reacting to then? Is it reacting to, so you're kind of outlining this situation where corporates are in a healthy place where they do have a little bit of wiggle room on the balance sheet. They have wiggle room, I think probably with their staff as well. There's been basically nothing happening in the M&A market. You can make these moves around the edges. Is like looking towards the end of this what the stock market is reacting to? Or is it just like everyone said AI on their earnings call, so you should bid it up 20% and call it a day?
Yeah, I mean, it's probably a little bit of both, but a lot of the concerns that we've been hearing about headwinds to the stock market, including this earnings recession that is very much expected by everybody. Everyone's been talking about how the economic recession that has yet to come is the most talked about recession in history, but the earnings recession for corporations has been similarly talked about for months. And here's what happens when that time passes with those months. If we're talking about an earnings recession in Q2 of this year, a year ago, then it's like you're looking forward. We're past Q2 now. We're still talking about this earnings recession of the past. So to your point, Myles, I don't think while we're going to continue to hear about how earnings were weak in Q2 and maybe weak in Q3, the market is looking forward 12 months ahead. It's always looking forward, right? The stock market, stock prices are discounting mechanisms. And the outlook seems to be a lot rosier than what we're facing now.
But how much of that risk do you think has already been priced in when we talk about future rate hikes, the fact that earnings could potentially disappoint here for this quarter and going forward? We haven't necessarily seen that earnings recession, but how much of that has already been taken into account, and then what that downside pressure could look like if not?
I think the coming to the end of the cycle isn't yet. It's sort of, I think it's what's kept us buoyant so far. I think actually there hasn't been enough pragmatism going the other way. The earnings recession risk that I worry about, I have a different perspective from Sam on this actually. Am I allowed to have a different perspective from Sam?
Of course. It's always good to have a debate.
Welcome. Part of the reason that corporations were able to keep their margins strong was because they were playing off inflationary expectations, right? If you guys were hearing prices are going up, input prices are up, supply pressures are there, you're willing to eat price hikes. Now you've got to say to the food companies, the apparel companies, knock it off. knock it off, right? Inflation's coming down. You can't keep hiking prices. And by the way, my wages, yes, they're still a little too hot inflation-wise, but it's clearly not going to keep going if we believe the Fed is going to do what it's going to do. So I think a lot of that margin cushion was created by inflationary expectations or animal spirits. Let's get Keynesian about it. And it's going away. It's going away because people are now beginning to believe the market. That's why I think the downside risk is.
And I actually completely agree with that.
I
completely agree with that. And I think that's what makes the outlook so murky, because one of the reasons why consumers have been as much as they hate inflation, they've been paying up for it, right? They're, you only ever hear about people complaining about airplane tickets after they buy the plane tickets, or it's like, oh, Disney World tickets. It's like, I was at Disney World and I paid this much, right? So it's like, it's because they had money. It's because of all this fiscal stimulus that they're still sort of, spending off, this excess savings number that we keep talking about, and all this stuff is starting to dwindle. So I definitely think that, that's helped, and there could very much be pushback from consumers, especially when their finances get a little bit tighter. So I think there's absolutely uncertainty out there.
So then in thinking, maybe coming back to the corporate point on that, and about how corporates think about setting up, their pricing structures and the things that they might want to do to their customers, did we not then enter like this new era of essentially the relationship between suppliers and buyers and what expectations are on the corporate side for where your costs could go? Like, was there not a big reset out of COVID? Was it a one-off inflationary period? People took price, people, tried to refill their inventories very rapidly, and now we're back to, I don't know if it's business as usual or, whatever that cycle was, that long moderation, great moderation we saw in the 2010s. Are we trending back towards maybe that environment on the corporate side?
I think we're heading back towards normalization, but I think the excuses that corporates had, other than wage inflation, have gone away, right? If you think about what shipping costs did during COVID, they were absolutely astronomical. And everyone said, okay, well, if I want my product, I'm going to have to eat the cost of air freight. That's gone. It's the wage inflation piece that is tough. But I think where the market is going to have less patience now is if management teams say, well, look, we've got margin compression or we've got to put prices up. Unclear if that's going to go through because wage inflation is high. I think at some point the market says, okay, you CEOs and executives, you know this was coming, you've seen the trend for a while, you had to manage for this. And if you're not getting it on procurement, if you're not getting it on productivity gains, you're not doing your job. So I think patience is going to run out. And
so I think that's also your last point there, I think that also speaks to the other side of the uncertainty to the upside, right? You have to offset this with productivity gains. Yeah. And AI is just sort of a catch-all for all this. But there is a lot of things going on with AI technology, and there's a lot of actual orders for this technology in place, right? And that also goes back to what we're talking about with CapEx orders. Mm-hmm. There's still a huge backlog of core CapEx orders, or however you want to call it, but there's a lot of business investment that's still going on. And that's also going to replace a lot of old equipment that was less efficient. So with the, whether it's AI, whether it's new machinery, whether it's, people with different kinds of skills coming in, there's potential upside there in terms of productivity gains to offset what might be lower margins because you're not able to pass things off through price.
Certainly. Well, we got to leave it there. There's a lot more to discuss. So, Ann and Sam, you guys got to come back to 770, back to the office here to continue this conversation at some point. But thanks so much for watching here on Yahoo Finance.